the big banks theory. This is Industry Focused Financials. Hello everyone, today is Monday, February 22nd, 2016. This is Gabby LaPera in the studio. We recently decided to change things up on the Financials edition, so we're having a rotating cast of analysts from now on. Joining us this week is Jay Jenkins. Thank you very much for agreeing to this.
Hey, Gabby, glad to be here.
I'm really excited to actually have you on. Maybe you will be able to come up with more clever opening lines than me. I feel like big banks theory, like Big Bang. I thought it was funny in my head, and then I said it out loud, and I was like, oh, that was terrible.
Not the most glamorous niche. That is for sure.
No, but this week, actually, we're kind of doing a listener question. I don't know what happened, but this guy named Derek Stritzinger apparently read my mind and wrote in about the exact topic that we kind of already had planned, which is whether or not this is a good time to buy big banks. Like, I don't know if you noticed, Jay, but the market has had kind of a rough start this year, although it's kind of rebounding. So everything's just kind of on sale, even great companies, just because the market as a whole is down. So the question, like I said, is now a good time? Oh, you know what? I almost forgot. Actually, it is 13F season, and I bet 13Fs would give us great insight onto, well, maybe some insight onto whether or not it's a good time to buy big banks right now. Did you get a chance to look into those?
Yeah, that was actually my first thought as we started talking about how we're going to approach this question. And so I went back, reviewed,
Sorry, I'm just going to interrupt you real quick. Actually, just for our listeners, 13Fs, just in case you don't know, are an SEC filing that institutional investors have to file, and it basically says what they're investing in. And that's anyone from like hedge funds to like big banks to individual investors like Warren Buffett or Jamie Dimon. Sorry, continue.
Right. Yeah, that's exactly right. Good explanation. So the beauty of it, the value of it is that we can see what, the quote unquote smart money on Wall Street is doing. One of the downsides is that there is a delay. So, the market, like you said, has been kind of crazy, since January. And so we won't know how these big hedge funds have reacted to that until next quarter when they release their first quarter 13Fs. So we are kind of looking in the rearview mirror a little bit with this. And with that said, when I went back and looked at these large firms, these sort of, if there is a household name of hedge funds, these are the funds. There's really not a whole lot of unusual activity in the big bank space. JP Morgan, Wells Fargo, Citigroup, Bank of America, all the usual suspects, these huge mega cap banks. They're the most widely owned. They are being traded. Some are buying, some are selling, but there's really not a consensus, no large, directional change over the past year. So again, that doesn't really indicate one way or another, but I do always like to kind of check in on what the real big money, real smart investors are doing. And in this case, it's sort of treading water, not really sinking, but not really floating any higher either.
Kind of just like a wait and see thus far anyway.
Yeah, exactly.
That's really interesting to me because I feel like big banks are in a far superior position in terms of stability than they were pre-financial crisis, and the Fed finally raised the interest rate, which is good news for big banks. But I guess, I don't know. I feel like the picture isn't so grim. So like, I don't know. From the surface, it's kind of like, oh, why wouldn't you invest?
I totally agree with you. It's not it looks a lot better than it did, say in 07, particularly than 08 and 09, certainly. Rates have been low since then, and that's been a major drag on earnings. When you're a bank and you're in the business of lending money, higher interest rates mean, higher income. So as rates rise, that should be a uniformly positive thing, and especially so at the larger banks. Again, the mega banks in particular, even larger regional banks like U.S. Bancorp or PNC Financial or even like BB&T. These banks have the sophistication where rising rates should translate pretty strongly to increased revenues, and that should drive higher earnings as well. So from that perspective, banks look to be on the cusp of a pretty nice jump. If they're valued now at say round numbers 10 times earnings, and earnings double, all things being equal, that should cause the stock price to rise as well.
Right. So I guess the way to think about this, right? I mean, it's not just like, should I buy a big bank now? This is the Motley Fool. We're never going to tell you like yes or no, right? We're gonna tell you here are strategies for looking through a really big bank's incredibly complicated 10Q to pull out the data that you need. So I think we've kind of got to start here. I think that the best way to structure this, just to preface this, Jay, I don't know if you know this about me, but my mother is a life coach. And I was her little guinea pig growing up. So pro-con lists were huge in my household, and in order to make any decision. Shout out to Mom. Thanks for doing a great job raising me, I think, anyway, personally. So why don't we kind of do like a pro? So like what's looking good for banks right now? Like what kind of metrics do we look at that look good for banks right now?
Well, the first thing that comes to mind is not, I don't know if it's really a pro, but it's just sort of an interesting time to be investing in banks. Bank stocks are like pretty daggone cheap right now. Typically, you value banks based on a price to book ratio or by earnings, price to earnings ratio. And by both counts, the big banks are cheap. I mean, as we're recording this, Citigroup is trading at about 55% of book value. Bank of America is even cheaper than that. JP Morgan's trading less than 1-to-1. Only Wells Fargo of the mega banks is above 1-to-1, and that's because their earnings are always so strong, and they do such a good job operationally. So valuation-wise, big banks are definitely cheap. The regional banks are also kind of cheap right now too, but tend to be a little bit higher. BB&T is trading just over 1 times price to book value. PNC slightly below, and then Huntington Bancshares is another kind of what I look at as a bellwether of the regional banks, is trading at about 1.1 times price to book ratio. Now, in the good times, you can see these ratios get up to size, 2, 1.8, 2 times. Some banks even trade even higher. So kind of with that longer term historical perspective, now looks like an okay time only because the valuation multiples are so cheap.
And I don't think it's because there's anything necessarily wrong with any of these businesses, because I think like the first thing a lot of people say to themselves is like, oh, the market's valuing it cheaply. But I think ultimately, while a market will is eventually efficient in coming to terms with what a company's price is, I think in like really short-term moments like this, it's really hard to just look at a valuation and be like, that valuation definitely says a lot about what's going on. You know what I mean? It's kind of more of an average is what you want to look at.
Yeah, absolutely. And with the market being so crazy so far this year, is JP Morgan really worth 15% less today than it was 2 or 3 months ago? I mean, no, nothing really has fundamentally changed. It's people are just reacting and trying to make sense of it, and that's, like you say, that's our kind of short-term opportunity. Now, there's a reason that banks are trading so low. There's everything has a cause and effect, and I'm sure we'll get into the headwinds a little bit later. But by and large, banks are pretty cheap right now.
Yeah.
Even on price to earnings perspective, looking at on a forward basis, Wells Fargo is trading just under 11 times forward earnings. JP Morgan at 9.3 times. I mean, again, these are not expensive. And you look at the chart, and it's come down since middle of last year, but not crazily so. While they were maybe at like 10, 11, 12 times back in July, September. Just to drop, 1 or 2 point, or from 10 to 9 or from 11 to 10, that's not a gigantic drop in terms of earnings. So the market recognizes that these earnings are real. The banks are safer. Like you said earlier too, go back to before the financial crisis. These banks are better capitalized. There's less risk. They're delevered. All these things are really positive. So that if there is kind of some sort of, I don't want to say crises, but some sort of like significant headwind, like a recession, or even just kind of a correction in the market, fundamentally, these banks are much stronger and should come out of this much cleaner, than we saw in 08, 09, even in like 2010 and 2011, where Bank of America had such a tough time.
Yeah, well, that was mostly because of legal fees, and they've put a lot of that behind themselves, which opens the door for them to profit, because instead of paying out because they've lost legal battles or because they don't want to continue them anymore and they just want to pay people to go away, they're going to be able to use that money to reinvest in themselves.
Yeah, absolutely. And Bank of America is a great example. Like you say, they traded down, I want to say it was almost like 0.25 times tangible book value at the nadir of that whole thing. And now, I mean, Moynihan's done their CEO, Brian Moynihan, has done just such a fantastic job putting all of that rep and warranty risk behind them. I mean, that's done. It's over with. And he successfully finished the Project New BAC, their cost-cutting initiative, billions and billions of dollars in cost savings. So, going forward, major improvements. Even though there are certainly still some flaws and some problems that all of these banks have to deal with, but much different situation today than in 08 or 09. So, I see the risk, the downside is I guess in a better place now. So for the investor today, I guess that's less to worry about. There's no generational kind of event, at least as best as we can tell.
Yeah. I actually kind of want to get back to something that I mentioned earlier, which is the Fed raised the interest rate, right? Which is good for banks, right? Like they make more of a profit when interest rates are higher because the loans that they give out have higher interest rates. They make more money.
That's
so
right.
what kind of ratio, what ratio does that kind of display itself in? What does that mean for big banks?
Sure. So with bank accounting, it translates to a metric called the net interest margin or net interest profit. And essentially what that is, it's the difference between what a bank brings in interest revenue from like loans or debt securities and what it pays out for its funding, whether that's short-term loans with other banks or larger, a more significant contributor being like your deposit account. So like the 0 point whatever percent you guys get on your savings account. So the difference between those is kind of like equivalent to gross profit at a more traditional, simple business model kind of thing. So as rates rise, the interest rate they're going to be able to charge on loans and get from debt securities is going to tend to rise faster than what they'll pay out for their funding and to deposit holders. So as that margin expands, it should correlate pretty directly to the bottom line, because the banks are already operating, the branch network, they have all the expenses. It's really a scalable kind of event. So it should have a pretty strong impact relatively quickly. Now, the flip side, though, is the Fed has signaled that it's going to start raising rates, but it really looks like it's going to be a slow, multiple quarter process. I mean, who knows when we'll get back to, 5, even 6% federal funds rate. If we do during the cycle, we may not.
Yeah, I think it's what at like 0 point something right now. It's not even 1%.
The funds rate is 0.25 is the target.
Yeah.
And it's trading. Actually, I think the actual effective rate is slightly higher than that by a few basis points right now. But in the historical context, that 25 basis point change it's next to nothing. I mean, it's hardly a blip on the radar screen. So while directionally it's good for the banks that rates seem to be about to rise, we've still got a long way to go for that to actually sort of materialize and to start seeing higher returns from that revenue source. So as a forward-looking investor, it's something good that we think is coming. But will it be this year? Will it be next year? Will it be 3 years? It's pretty hard to say.
Right. So I feel like we've kind of done the pros. Do you want to kind of get into the cons a little bit?
Sure. So a lot of the things we talked about as positives, I kind of, there's reasons that the world has, the banks are trading cheap, for example. So we like the future of banks because I mentioned rising interest rates. Well, why doesn't the rest of the market recognize that? Why aren't the valuations going higher? And I think it also comes back to kind of what we talked about, the new world post-financial crisis. I mean, a lot of this comes back to regulations. JP Morgan is a great example. JP Morgan is classified at the most systemically important tier of the new global systemically important financial institution capital requirement regulatory regime.
Mm-hmm.
It's a mouthful and it's pure regulatory jargon. But at the bottom line means JP Morgan and also other large banks have to carry more capital on their books than they ever have before, and that means they can't lever up as much. So your return on equity is going to be lower. Return on assets are going to be harder. It's going to be harder to generate the same earnings per share as it was before. Just because you can't juice it when you're sitting on such an extra capital buffer, that money's got to sit aside rather than actually be put to work to benefit shareholders. Banks with simpler business models don't have this problem quite as much. Think USB, US Bank Corp, or Wells Fargo are great examples of that. They're not as global. They don't get into all the crazy investment banking stuff that JP Morgan or Goldman Sachs, some of these other banks do. So for these guys, they don't have that same extra capital buffer requirement.
But they do still have more than they used to, which I think
Absolutely.
is important to point out. Like pre-financial crisis, they weren't required. I mean, like now the federal government tells these banks whether or not they can even pay out a dividend that quarter.
Yeah, totally. The Basel Accords that are being unfolded is causing, a rising tide lifts all boats. And in this case, that rising tide is just more capital for all banks.
Yeah.
And then on top of Basel III, Dodd-Frank is also having some major implications in terms of capital, but also, in terms of costs. While net interest margins, we hope, are going to be expanding since the financial crisis, big banks have really struggled to overcome some of the cost burdens of dealing with Dodd-Frank and putting in the systems and bringing in the people to kind of manage this whole gigantic transformation across the whole industry. I've got an example for you on this. M&T Bank is a very high-performing regional bank in the northeast of the U.S., but headquartered in Buffalo. I mean, over the last 30 years, I challenge you to find a bank that's done better for shareholders than M&T. I don't think one exists. But for the last 3 years, the bank was handcuffed trying to acquire Hudson City Bank Corp, which is maybe 25% the size of M&T Bank at the time. Regulators wouldn't let it go through. The only way they got approval, which just happened a few months ago, was by spending literally nine-figure sums of money to completely revamp their regulatory compliance program.
I remember this. Was this the one where there was like a woman in, I think it might have been Maryland, where she was laundering money and they like didn't notice for like a year.
Absolutely. It's the anti-money laundering compliance is really where they got beat up. And it's the kind of thing too, from a consumer perspective, the bank needed to do a better job. But from an investor perspective, I mean, we're talking hundreds of millions of dollars over multiple years. The bank's profitability suffered, their efficiency went it tanked. It was an ugly scene, and the bank's only just now come through it. This is happening all over the country at every different bank. Maybe not on this scale, maybe not the headline grabbing $120 million that they had to put into it, but small banks, large banks, medium banks, compliance departments are growing. These systems are complex. It takes a lot of resources, a lot of money to handle it. So that's a real significant headwind, and that's not going away. For investors today and for investors tomorrow, that's a reality of being in the big bank business.
That's definitely created some like very interesting currents within the banking industry too. If you look at the Federal Reserve has a kind of like they release reports periodically, and you can see that the number of banks in the country has decreased over time, and like pretty drastically. Not surprisingly, after the financial crisis, a lot of smaller banks got eaten up by big banks. And part of it was the regulatory requirements were much more stringent, and small banks just didn't have the capital to invest in themselves to like get there.
Absolutely. For the kind of community bank niche, less than $10 billion in total assets group, a lot of these banks are looking at it going, we have to merge to get to that 5 to 10 billion point, just to be able to absorb the cost at scale and still provide, the kind of shareholder returns that people have expected. They want to pay out a reasonable dividend. These banks want to buy back shares. They want to, post strong earnings and grow.
Yeah.
And it's for a lot of small banks, it's too much.
Yeah, I'm sorry. I kind of diverted the conversation into small banks. I know you love small banks. I'm sure it wasn't a problem for you. But let's actually kind of flip it to the other side, which is big banks. Like right now in politics, it's kind of a hot button issue, right? Like everything from Hillary Clinton's JP Morgan speeches, which she isn't releasing the transcripts to Bernie Sanders saying like, I want to break up the big banks. Like, that could be creating some kind of like headwind on these banks, don't you think?
Oh, absolutely. And it's coming from both sides of the political spectrum, just in kind of subtly different ways. And even some kind of neutral observers, for example, Neil Kashkari, who's the newest member of the Federal Reserve, he's the new chief in the Minneapolis Bank. He came out in his very first speech in that position, which is a non-voting position, so he doesn't have that much influence over policy decisions at this present time. But it's still pretty significant given that he's a Fed president. Anyway, he came out and said pretty much specifically that the whole industry needs to be transformed. Bold changes, bold new rules, force these banks to be broken up. That's a dramatic change. I mean, go back to like Teddy Roosevelt 100 years ago, when the last time we kind of saw some of these, populist calls to kind of shrink corporate interests. Now, will that happen? Who knows? I don't have a clue. But what it certainly does is creates uncertainty for investors. And that uncertainty is a major headwind. You're going to invest your dollar into an asset, into this stock. And you want to have some sort of reasonable expectation for what you're going to get next year, 2 years, 5 years, 10 years down the road. And when you have major political figures at the Fed and potentially in the White House, anywhere else, that really, really kind of puts a question mark over what's going to happen. And that's driving, I think, uncertainty and reducing valuations as well. So just yet another headwind kind of from something external to fundamental bank operations.
Right. Not only that, but like the global economic situation is super uncertain right now between China and Europe, and especially with like these global investment banks. And oil. Don't forget oil. It makes it a lot more complicated. However, all of these things like put together, that's part of the reason that the valuations are so cheap right now. And if you fundamentally believe in the business models of these big banks, which I don't think there's any reason not to. Like if you look at their fundamentals, they're doing fairly well. Like considering how much like regulatory money that they've had to spend, like how the depressed interest rate environment has affected them. I think that these banks are really doing a lot better than I would have thought.
I totally agree. And to me, it boils down to the issue of quality. If you can find a bank that's just a really quality operation, that's just rock solid fundamentally, those banks are going to do better in good times and bad. You can ignore a lot of these external factors. If
Yeah.
you invest for 5 years, 1 or 2 quarters today is kind of insignificant, in a lot of ways. So you don't have to worry about that. Banking is not going anywhere. People will, need somewhere to deposit their cash. People will need help with their financials. People do need loans. The people want to own houses, and in America, the mortgage loan is the most common way to accomplish that. So, in terms of quality, to me, I look at J.P. Morgan, and if I encourage you guys to go look at J.P. Morgan's annual report, fourth quarter and full year results. And there's a chart in some of their material for investors that shows earning per share growth over the past 10 years, essentially since Jamie Dimon took over. And it is just the most beautiful linear chart, straight up, barely a hiccup for the financial crisis. It's remarkable when you think about all the changes, all the stuff that's happened, just the chaos, between say 2005 and today. And it's just absolutely remarkable how consistent and how profitable that company really is. And, in that context, you understand why Jamie Dimon was willing to, plop down $25 million or whatever it was to buy JP Morgan shares earlier this month.
Yeah.
You look at that chart in that context, I mean, it's going from the lower left to the upper right, just like clockwork. So, and to me, that stems from the quality. It's the operational excellence, the fortress balance sheet, and all these things. And of course, Dimon, I think, is a fantastic banker and deserves a lot of credit there too. But
Yeah. I mean, for me, it's US Bancorp.
Great bank. It's unbelievable. It's such a simple business model.
But for them is insane compared to all the other big banks. Like, I think it's somewhere in either the high 40s or very low 50s, which I think the next closest one is Wells. And that's a huge thing. And it is, you're right, a very simple business model. And I know all banks say this, but they actually are fairly conservative underwriters. Like, they do a really, really good job of making sure their balance sheet is in check.
I totally agree. And it's amazing they can do it at the size. They're
huge.
Several hundred, almost $1 trillion in total assets at this point. And the Wells Fargo is in that same sort of mold. Very conservative, ruthlessly efficient on costs. Credit quality is always paramount. And it works. It speaks to that, like we said, quality.
All right. We are running out of time / have already run out of time. Thank you very much for joining us. As usual, people on the program may have interest in the stocks they talk about, and the Motley Fool may have recommendations for or against, so don't buy or sell stocks based solely on what you hear. Contact us at industryfocus@fool.com or by tweeting us at MFIndustryFocus. Let us know if you have any questions or what your favorite bank stock is. Thanks very much, Jay, and we'll see y'all next week.